This is a presentation coming to you from MacroVisor, where macro meets momentum and we find opportunity. And this is a segment that I used to write up every week and has now become more visual in nature. And I'm going to make it a video segment. I'm going to start doing them live too. I think it'll be kind of fun. And then, of course, you can catch them live or later on Twitter or YouTube as well. The first chart's one we've all been talking about, right? There's COCO. We've all been talking about COCO, right? Some of us longer than others. Some of the trend trading friends I have, we've been talking about this one since really 2023, like mid 2023, when it started to catch our attention. But then it just did this incredible breakout, the likes of which, this is rare. This type of move in commodities where it moves like a cryptocurrency or a short squeeze is extremely rare to this magnitude, where the price of cocoa had almost tripled over the course of, just a bit over a year and a half or so. So there are factors that are driving this. There's the bigger picture factors, which is drought. There's larger amounts of demand. You have these El Nino weather patterns that have created sort of feast or famine for farmers in terms of rain and drought. That's a part of it. And it's also putting pressure on some of the candy companies, right? You have Hershey's and Nestle coming out and actually directly talking about cocoa prices now. And you finally have hedge funds record long positioning in cocoa. Does that sign that the party is closer to over? Maybe. We did see a pretty big pullback today. The stuff was down over 7%. Next chart we have, U.S. market breadth is the weakest since 2009. This one made the rounds on Twitter. I had posted it, went pretty far, so I thought I'd talk about it just a little bit more. This is a subject we've talked about, its breadth, right? And the market doesn't have very good breadth. It has halitosis breadth, if you will. This is a ratio chart of the S&P equal weight versus the S&P market cap weight. We can see the market cap weight is just massively outperforming. This doesn't typically happen in the context of a bull. In fact, this type of move typically happens in the context of a bear market. So it's very interesting to see it happening during a time where we're making all-time highs, and yet that participation is overall relatively narrow. And we can see that in this chart as well. The bottom chart kind of shows the inverse, and then the top chart shows the two overlaid one against the other. The equal weight in red, the S&P 500 market cap weight in black, and you can see that variance, that sort of dispersion between the indices that started in early 2023 and has broadened out since then. Not the rally, but the divergence between the two. Something to pay attention to. If we're bullish, we really do want to see this rally broaden out, because the material risk that any single stock that's been leading the way goes lower is really bigger and bigger of a risk for this rally, because it's now at this point concentrated in just about 5 stocks. And when we drill down to skew, this is a measure of the distribution between premium for puts and calls. Right now, it is so thoroughly leaning towards calls that you could say it is a bit stretched. Why is that important? Because what that's telling you is that this is a market where there's not a lot of concern about downside risk. And I think that often happens, particularly when you see this positive correlation between VIX and SPX. It typically happens at a time where there is a bit of market euphoria. We're certainly in that type of environment. There's not a lot of appreciation for downside risk here. So that risk, that downside could become more problematic, it is elevated. That is to say, there's a lot of folks that are very long risk and very short vol. And if they had to reverse that positioning, that could create some tumult. The next chart we also have here is hedge funds selling tech pretty aggressively of late. Who's buying it? Folks like you and I, retail, we're buying it. And I think that is a little bit of a concern, that you see the institutions, whether it's hedge funds or some other areas of managed money, they have actually been letting go of some of this concentrated tech positioning. And we can see why. Tech elevation is elevated. It's in fact quite elevated. So companies either need to keep growing faster and faster right, to meet these expectations. And Apple really hasn't done quite a good job of that. So it's no longer the Mag 7. Tesla isn't either. So it's really become the Mag 5. Those 5 stocks now have to keep the party going with explosive growth, or these lofty valuations do become a bit risky. Speaking of valuations, 2024 profit growth is actually being marked lower by analysts. Now, we could interpret this one of two ways. We could say, well, this means that there's a lower bar for companies to beat expectations. That would be true. We could also interpret this as saying analysts are seeing a broader slowdown in earnings that may indeed manifest. So we'll have to see what ends up playing out in the quarters ahead. But one way or another, that optimism that we had going into this year is being checked a little bit. We also have hedge funds running record gross leverage. That's what this chart is showing. Their gross leverage around 290%. That's about the highest it's ever been. Now, let's talk about what gross leverage means. They're shorting single stocks. Like, a lot of the crowded trades, they were really short Mara for a while. We know how that turned into an explosive short squeeze multiple times over the last several months. One of them was a near triple for folks at TraderAid, where I identified that as a squeeze set up in December, and it proceeded to explode. And now we've got another one where we're just starting to take our core off in Mara, but we can see what's happening. Like, as those hedge funds have to get out of some of those crowded shorts, you have these explosive upward moves. There's usually a catalyst that leads into them. On the other side of it, however, they're very, very long the Mag 7, right? And so you have this bit of rebalancing that happens sometimes where like the NASDAQ is drawn down and the Russell's being bid. And you have to ask yourself, why? Why is that sort of trade playing out? Well, it's often this same book kind of flattening out a bit. They're taking off some of their extended longs. They're taking off some of their extended shorts. So you see those crowded shorts squeeze higher. You see some of those extended longs consolidate or even move lower. Now, I think that this book, being as leveraged as it is, does create some risks for this market, because if you did have a more rapid unwinding of that extended Mag 7 positioning, that's the biggest chunk of the S&P and the NASDAQ, so that could create some turbulence. So, again, it's not saying this is an imminent risk. It's more of this is a risk to be aware of. Now, let's talk about Nvidia for a second. It's been top of mind for many people, and with good reason. The company has joined the ranks of the $2 trillion club, or at least it had 1 foot in and 1 foot out and then 1 foot back in. But it's also become a greater and greater part of the single stock options market, to such an extent now that it's about a fifth of premium traded every day in that same market, which is pretty incredible if you take that into consideration. So I'm looking at Nvidia here and saying, boy, this reminds me of what we used to see in Tesla. Tesla used to do the exact same thing. You would see Tesla kind of have this big amount of premium flowing into single stock options on the call side, and it would drive shares higher and higher. We've seen that kind of move away from Tesla. It's no longer such a big part of the options market, where at one point it was bigger than Microsoft, Apple, Google, Amazon combined. Now Nvidia has taken that crown. And speaking of Nvidia, data centers serviced by Dominion Energy, and we can replicate this across a number of different energy providers, we can see that projected capacity surging over time, continuing on that trajectory of growth. A lot of this is from AI, which means there's going to continue to be demand for natural gas power, for, hate to say it, coal power, but also for solar, for wind, for really all sources of power. We can't be too picky with power. If we want to have this sort of technological revolution, we need to have all the power possible to feed it, which means these data centers need to be very well supplied with electricity so that they can continue to distribute it to data centers that are becoming hungrier and hungrier, because AI compute is orders of multitude more energy hungry than traditional compute. So another interesting chart here, shifting gears a little bit, is just talking about tech and just how disruptive it can be. Look at this chart of Uber, Lyft, and New York taxis. You can see how Uber, and to a lesser extent Lyft, really ate their lunch. This had to do with the convenience of ordering from your phone, the ease of being picked up pretty much wherever you want, not having to flag down a cab or compete for it, and then also disruptive pricing models. And you could argue that maybe they're not necessarily fair to the contractors who are treated more like employees, but at the end of the day, we can see the results are clear. They have gobbled up that market share, and this is a recurring theme that you see with disruptive tech. They come into a legacy industry. They disrupt it with a business model that allows greater convenience, better price competitiveness, and otherwise, and they expand. Amazon was one of these companies that did this in the e-commerce space and really changed that entire place. And Uber and Lyft did the same thing in ride sharing. Now let's shift gears a little bit because tomorrow we've got PCE coming up. That's the Fed's favorite flavor of inflation. And core CPI in the last reading was on the rise, which suggests that we could still see higher core PCE coming in tomorrow. We also have reasons to believe that from the labor market, we've got hourly earnings coming up 0.6%. You annualize that, that's 7.2% year over year. If it continues at that clip, that's the kind of reacceleration that can create some more pass-through inflation pressure. Similar with services PMI, the diffusion index showing more respondents talking about higher prices being paid. And then on the other side, NFIB small business surveys talking about small businesses planning to charge higher prices over the next 3 to 6 months. And finally, we saw it with PPI, with input costs on the rise, and of course, shelter costs continuing to rise. So there are reasons to still be guarded about the optimism regarding disinflation. We could see things become just a little bit more sticky here. The next chart I have is looking at PCE specifically, which we have coming up tomorrow at 8:30 a.m. And we could see this coming in higher than expectations. Bloomberg Macro is looking for 0.4%. That's the survey of analysts that are projecting this out moving forward. If you annualize 0.4% PCE at core, that would be 4.8% year over year, which again is not going to give much comfort to the Fed. So we do need to look at this with some degree of concern if it does begin to come in higher. If we see these data points of inflation coming in higher than what is expected, that could continue to recalculate Fed funds projections for where the Fed's going. A quick note about Fed funds futures. These are not meant to predict the future. I know the name sounds like it is, but it's much more valuable to look at it as a tool as to where the market's expectations are in the here and now, because if those expectations don't reconcile with what actually plays out, then there are opportunities that can happen from that, particularly in the rates market and places like 2-year note futures. So you can see that as we went from, the expectation of 5 to 6 cuts this year to 3 to 4, rates have been moving higher. Particularly, we've seen the 2-year note rate move quite a bit higher from where it based. This is important because what this is telling you is the market is now recalculating the resolve of the Fed in light of stronger economic earnings and inflation data than what was expected, as well as more resilient labor market data. The Fed will be coming out with their survey of economic projections at their March meeting, which will tell us their outlook on inflation, economic growth, and the policy outlook from the infamous dot plot, or where respondents from the Fed provide their expectations as to where they see rates moving in the near and intermediate term. That could have a further effect of resetting market expectations. Here's the chart we talked about just a little bit earlier. Small businesses signaling prices increasing over the coming months. And we can see that chart has a reasonably strong positive correlation with US CPI year over year. So we do want to pay attention to this survey because the more small businesses that are saying they're going to raise prices, the more likely it is it drags inflation higher, which could push rates higher, and that could have a number of other consequences. And the last chart I'm going to share with you all is interest payments by U.S. households surging on non-mortgage debt. This is credit cards and other kinds of revolving debt where they pay interest rates that float rather than are fixed. And this is really a concern for the, I would say, bottom two quartiles, the bottom 50%, where they're actually paying by credit card to make up more of their everyday living expenses. The top quartile have never done better. And that's a key theme in this K-shaped economic outcome, where there's a whole group of consumers that are doing really well, but then there's a whole other larger group of consumers that represent, a decent part of the economy that aren't doing quite as well, but are being overshadowed by government spending and spending by that top quartile. So we'll be interested to see what PCE tells us tomorrow about inflation, about consumption. And if you missed if you weren't able to see this whole charts of the week, the recording will be posted shortly on YouTube and Twitter. So thanks for tuning in. Check out my work at macrovisor.com as well, where we talk more about how macro meeting momentum can equal opportunity for trading and investing. I'll catch you soon.